marching up this time. Oh,
Hey, Wayne.
hey, Tom. Thank you for hitting the record. I realized that I wasn't recording.
I saw that, so sorry about
Yeah.
that. Maybe a little late, but
Oh, welcome back. I'm glad you're here. So, anyways, we had some really good questions about correlations and commissions. And hey, you traded in Europe with interactive brokers and everything like that. How was the commissions in something like the Sleepwell portfolio and Awake that you trade,
well,
you know,
it's a US
stocks?
account, so it's the same as it didn't really matter where I was. No,
Okay.
it was just a normal US account.
Yep. So, and limited commissions, I would assume, but
Yeah, I think stock commissions at IB are zero now, aren't they?
I thought that they were zero. But we had someone in the chat that's trading out of Europe, and it looks like there's some commissions over there.
Oh, maybe with the EU account. I don't know.
Yeah. So I'll dig into it later. I just didn't know if you knew anything about it. So anyways, and we were talking about the quantitative easing. We were talking about the shadow rate, and then I was about to dig into the yield curve and the inversion of the yield curve. And then, yeah, so that's where I am right now. How are you?
I'm good. I'm looking at the Interactive Brokers commissions, and for Interactive Broker Lite, they don't charge a commission, but I think they have some kind of regulatory or exchange fees. And then the IB Interactive Broker Pro fixed is 0.5 cent per share for under 300,000 shares. So it's not quite free, but it's pretty close.
Okay, yeah, so it's almost negligible. It really shouldn't notice anything on
Yeah,
returns.
yeah, you shouldn't really pay attention to that.
Perfect. Yeah, I'd be more concerned about taxes more than anything.
For slippage
Um,
too, but stock's really not so much slippage.
yeah, there's no slippage. Literally, I throw in market orders in all of these things. Like even the leveraged ones, most of the time they're market orders.
But the
Unless
spreads are
they're
like a
really,
penny or
yeah, I mean it's nothing. It's so minimal. Normally you waiting for a limit price can sometimes cost it more. But like I had said, there are a few members that are really good at day trading and they do a really good job at getting execution. So you can make a little bit of bonuses on those. So anywho, the yield curve actually inverted, the 3-year inverted today. So we officially have a tens and threes inversion.
wow.
Now the tens and twos hasn't inverted yet, but the tens and threes did invert, and you can see how low the tens and twos are. I mean, it's so close to inverting. It's just disgusting.
Yeah, it looks like it's going
Um,
to do it pretty soon.
yeah, the forward looking yield curve is looking like it is going to invert next year for sure. So anyways, the whole thing about yield curve inversions that people typically talk about is what the is that they normally come in before recessions, right? But during really high levels of inflation, they don't normally always act like that, right? So sometimes you'll get an inversion and a deep inversion in high times of inflation because the Fed is actively tightening, and they're kind of over tightening to stop inflation. That is not the case right now. We are getting a yield curve inversion with an extremely accommodative Fed. So this is why last week's move was like nothing. Just to kind of here, I'll make it. Let's see, we'll go bright pink. Why not? So down here, this is where the Fed is, right? The Fed's on the front end of the yield curve. This is where they're manipulating everything. They're not doing any mortgage-backed securities. They're not doing any. They're not buying any long-term securities anymore. So they're no longer manipulating this portion of the yield curve, right? So what happens is this is true investor sentiment right here that is buying the bonds or lack of buying the bonds, right? So when you start to get a lift in this front end, right, it depends on what the Fed is doing and what they're targeting. If they're targeting a low, which is basically 25 to 50 bips, right, then it's going to pull down this front end. Well, what happens when they're pulling down this front end? In order to keep this down, they have to buy a substantial amount of open market, treasuries to keep this suppressed, because its natural inclination is to pop up to about this level. It wants 2%, but they're artificially suppressing it down, which means that they're printing money in some sort of way. They're being accommodative to markets significantly right now, right? It's not like we are inverted in a yield curve like what happened in 2019. Let me show you what happened in 2019. 2019 is here. We'll probably grab any part of 2019. I got it like right when, come on, where is it? There we go. So here's 2019. And this is where you can see this kind of belly or the sag right here, right? The sag in the yield curve. When we get the sag in this yield curve, it means that the Fed is actively tightening monetary policy. What they're doing is they're propping up the front end of the yield curve by pulling liquidity out of the treasury market, right? And so when this happens, they are pulling cash out of the system. They're not putting cash in, that's for sure. They are pulling cash out, right? So this spread, this front end of the yield curve wants to match this natural linear slope, or it should actually probably match the square root of time, but we'll get into that another day. So this is how much the front load is tightening right here. And you can see that right now they are not doing the same thing. They are pulling it down, right? They're keeping it down. So which means investors want higher yields. And as they want higher yields, they have to react accordingly. Otherwise, they're going to print so much money, it's going to create runaway inflation. And vice versa, if they invert the yield curve on purpose and tighten very aggressively, then it's actually going to stop inflation. But right now, they are not actually stopping inflation. They're still adding to it. So that's when they're going to sit there and say, hey, we need to do something else, right? So they're going to have to ratchet up significantly further and faster if inflation is what they're going to want to stop. And of course, anytime that rates go up, it means borrowing costs go up. As borrowing costs go up, it typically means growth in businesses slow and demand in consumers slow. And cars, houses, all of those types of things become more expensive because debt becomes more expensive. And the spread between the long end and the short end of the yield curve means that banks start to be a little bit stingy on who they lend credit to. So anyways, that's just kind of where we are, guys. Housing supply, by the way, is up above 6 months again. So we're pretty much back into a normal market for housing supply. Yeah.
I saw an article about talking about housing and how interest rates are going to drastically slow the growth of real estate prices, which I kind of agree with. I mean, the housing prices have gone up so much. I mean, just our house in Colorado Springs, I think 35-40% in 3 years. I mean, that's not sustainable.
You're 100% right. I mean, here in the Metroplex here in Seattle, Bellevue area, your average home is probably maybe 800,000. So if you've got an $800,000 home on the market, right, and interest rates go from 3% to 4%, right, and predominantly to a new buyer, right, 90% of your mortgage payment is interest, right?
Initially, yeah.
So if that interest rate goes up by a percentage, right, and we can just do the quick math here, and this is just quick and dirty, but if you've got 800,000, and let's just say that you've got let's say you've got a 3% interest.
That's call it 24,000 a year in interest.
Yeah, $24,000 a year. Let's say you divide that by 12 months. So that's $2,000 in interest a month, right? That's what you're paying, right? Well, let's take that same $800,000 home and let's multiply it by 0.04, which is the interest rate. And the interest rate's actually higher than this now, but this is exactly what just happened over the last month and a half, right? We went from a 3% interest rate to a 4.5. So here we'll do 4.5. That's what current mortgage rates are roughly, right? That's $36,000 a year.
Or
Divide
$3,000 a
that
month.
by, so your mortgage payment to buy the same home went up 33% a
It went up,
month.
well, it went up 50%, 2,000 to 3,000.
Oh yeah, 33, yeah, of its end value. So yes, you're right.
Yeah.
Thank you. 50%. Yeah, that's huge. That's a
And you're not
monster.
even touching the principal yet.
Right, exactly. So this is what happens is it just prices people out instantly. But this is also what makes home prices go up exorbitantly when rates drop aggressively, right? When rates
Because now you can
drop
afford
aggressively,
more of a house.
there you go. So the demand for those more expensive homes goes up, and in a free market economy, we sit there and raise the prices because people can afford them more. So prices instantly spike, right? And we've gotten pretty fast about aggressing these. But let's just say, I mean, let's just say miraculously that we get up to like a 5.5% interest rate this year, which would just be gross, right? That same $800,000 home times 0.055 divided by 12. I mean, you can see how quickly it's just like now, in order for someone to afford this $800,000 home at $3,700 a month, they have to
Interest.
make, right, and that's just an interest, right? They have to make 125x what they used to be able to make, right? And wages aren't going up that fast, right?
Definitely not.
So yeah, it definitely squeezes demand for home prices. Also, let me kind of throw this little wrench into the mix. 1 out of every 5 homes right now is bought by a business. So
Oh,
that's either a REIT, a fund, an investment company, something like that. 1 out of every 5 homes in the United States is not bought by a person. It's not someone to,
it's going to go move in there,
right,
primary residence kind of thing.
right. And that's a dramatic change from what we had in 08, right? In 08, businesses and investors were very, very, very low in the market, 2% or so of what homes were being, 1-2%, right? Now it's like above 20. It's like, I think it's like 22% of homes are being sold to businesses right now. So that's a lot of investor and speculative investments in the home prices. So, and we all know what happens when speculation gets selling pressure. So it could be quite interesting with yields going up and interest rates. I mean, I definitely wouldn't sit there and call another 2008 crash or anything like that.
Well, they
I
were
just
just talking about decelerated growth. So they're not talking
Yeah,
about contraction.
yeah, and I think that's relatively normal. By the way, GDP now, this is Atlanta Fed, right? Their GDP now forecast is like just barely over 1% for Q1. My models are still showing roughly about 0, so it'll be interesting if we can actually pop up to this 1. And then next quarter is going to have like a slight improvement, but on a year-over-year basis, it's such a nasty time frame. So it'll be interesting next quarter. By the way, here is like OECD's data for what their forecasts are. So you can see here the rate of change significantly slows. So you can see we just for reference, COVID, we go from 98.7 to 89. So that's a pretty big drop,
That's
right?
a big drop. Yeah.
Yeah, that's going to be a nasty thing, right? And that's what COVID did, right? But since then, we've had huge acceleration. I mean, look at this 89 to 96. And this is real GDP forecast, by the way. So huge acceleration. And then we had Q3 of last year, and then we had Q4 of last year, which was actually still somewhat of an acceleration. We started to build up from there. Then this first quarter, right? We get a contraction based on their forecast, but then we get an even more of a contraction in Q2, and then about the same, even more. And so you can see the kind of pattern. We don't start really picking up until mid 2023. So, just to kind of keep all those things in mind of, where the trajectory is. If you look on a chart, you can kind of see the net effect. You can see that slowing happening in the United States versus the rest of the world. So tightening dollars, things like that. So just kind of knowing where we are macroeconomically, that like the super bullish, forward looking, everything is going up to the moon of what we had last year is not here anymore, right? So can markets still go up? Yes. Can markets chop around? Yes. Do markets go straight down? Not typically, right? Not unless you get COVID or something. It's not like we're, projecting out the end of the world here. We're just showing that, or I'm just kind of talking about that the buy every dip like a crazy man of last year isn't quite here yet. So, just, risk adjust accordingly. So yeah. How are you doing with everything going on your end, Tom?
Well, the boxcar trades are doing pretty well.
Fantastic.
I just closed the second one. Well, I had one Thursday, closed Monday for 3.62% profit. And then I opened one up Monday afternoon and closed it today for another 3.61%. So pretty good
Nice.
week, up 7.2%.
There you go, man. That's how you do it. There's so much, opportunity in the markets right now. It's just amazing. So, very, very, very good times.
Yeah, definitely. But that's going well. I'm working on a spreadsheet. I can share my screen for one thing. It's kind of interesting. I'm kind
Sure,
of
go for
working
it.
on.
We'll go on a little side tangent.
Yeah, let's see here. Where's this? Right, I got 4 screens. I got to pick the right one. Okay. So you see an Excel spreadsheet.
It's coming up now. Yep.
Okay, so basically what this is a planning tool for the boxcar trade. So we put in this actually pulls in the current SPX price. It's closed now, so it's not moving. Futures are, but then you pick the expiration date you want. I think normally it's a Friday, so that would be well, this Friday is the 25th, so let's go like April 1st. So that's 9 days expiration. And then we look up the volatility and thinkorswim, and this is 1.3 to 1.5 standard deviation range. Then that gets highlighted down here. And then I take the top, I'm starting at 0, which is the spot price, and going down 5-point increments. So this is the top 50 strikes, so about 250 points. And this is the median open interest and the median volume. So half above, half below. And if it's above, it's a light green. If it's 3 times the median, it's a dark green. So you can see instantly where the heavily traded options are. And then this green is the standard deviation range that you've set. And normally the boxcars start around 10 to 12 delta, which you can see here. It's about right. But if you're using this to pick a strike to trade, you'd probably want to favor the lower delta with some decent volume, and maybe even go to here. You're getting $1.40. Maybe I think Dan uses $1.60 as his minimum, so you'd probably want to cut it off maybe here. But this has decent volume enough to get your fill. But this strike is kind of light. This one's really light. But you can see which ones that people are actually trading, which is kind of fun.
And that's awesome. I mean, and by the way, Dan, he trades these short-term trades and things like this, and this is, his alpha generating, this is what he trades, but he has a large chunk in a passive portfolio, right?
Oh, big chunk. Yeah, I think
Right.
6, 7 figures. And then
Right.
his trading account is maybe, I don't know, maybe 200,000, maybe less, but he's doing like 3 lots on his intraday futures trading. It's play money. And then for the boxcar trades, I think he's using about a 10 lot, which is maybe a $20,000 trade. And he does one on the SPX, one on the Russell. He said he's tried Amazon and I think Tesla, or it was another high beta stock, and they didn't work out as well as the indexes. And SPX was better than the Russell. But
And this
it's
is,
just play money for him essentially.
yeah, this is exactly how professional traders do it. They position size their higher risk trades smaller, and they have a bankroll of a passive portfolio that sits behind them. It's why I made the sleep well and the awake. It's the same situation. It's like you just can't run everything like crazy. Is Boxcar an iron condor variant? I believe it's all on puts, isn't it?
Yeah, it's all puts. Let me see if I could
But
pull
it
up a
but
risk chart for you.
it is a condorized structure.
It
So
resembles a weird ore. Just a little bit of history with that. The iron condor back in the day, people were kind of hot and heavy on it, but Dan Harvey again came up with the idea of kind of this shape risk graph. So iron condors in a equity market typically is trending higher. So the iron condors tend to get hit more on the upside. So he would have less risk on the upside, and that's kind of what the boxcar trade is. Only the um, those trades are more like 30, 60, 90 days expiration. This is like a week out. We'll put this on Thursday or Friday to expire the following Friday. So you can see the
mm,
theta here is 236. It's kind of crazy. Um,
and the only risk that you run into these types of trades is intrinsic value in your options. So you do have to be vigilant on it intraday, right, Tom?
yeah, so like here we start out with a 10.5 delta, and we use this kind of monitor tab to monitor. This is the mark to sale ratio. So you take the current price here versus what you paid. So say I paid $8 for it. Now that ratio of the current price to what I paid is a dollar or 1.3 to 1. If it gets over 1.7, 1.8, then it's getting a little bit out of control and you need to do something. And what Dan will do is what he calls a leapfrog. He'll buy in a couple of these shorts and sell them lower down here. So basically he'll leapfrog it over the long strike essentially. And but that lowers your delta and that helps keep you out of trouble. The delta, we monitor that. Again, it starts around 10 to 12 delta. If it gets up to 19 or 20, that's also a time you want to leapfrog or do something to address your problems. The debit spreads. So this is kind of a push me pull you kind of thing. So you have a credit spread here, and then change color, a debit spread here. So as the market's going up, this is losing money and that's gaining money. And as the market goes the other way, probably should have switched those colors. This one will be making money and this one will be losing money. So what we do in the debit spread is once this makes 10, 15% of its potential profit, we we usually just either close it and just reposition it and harvest that for a credit, and that'll lift this T plus or expiration line up a little bit. Or you can, if it's getting later in the trade, you can actually buy this in and sell a higher one and kind of reduce the size of the debit spread, and that's also for a credit. So we do this harvesting as the market moves up and down. And the reason you want to do that harvesting stuff is if you don't, say the market goes down here and this debit spread has a nice profit, but then the market reverses and comes up here, all that profit just goes to zero. So you're just giving it all up. So you basically want to take the profit while you have it, convert it to cash, and then reset your debit spread. And then we'll do things like if this is a 6 lot, I'm looking for about a 6 delta for the position. So about +1 delta for every credit spread that we're selling. So you're using the debit spread to help adjust this to make sure it's not too delta heavy, but not negative delta unless you're really bearish on the market, I guess. But
Mm.
um, and we also don't like to put these right at the money. So if you put the debit spread, say at the money or in the money, like here, if the market immediately starts moving against you, you paid a lot more for this option than we did for this. So this one will start losing money a lot faster as the market moves higher. So we tend to put them on a couple strikes out of the money. But that's kind of how the
Nice.
boxcar works.
Sweet. There was a little blurb
Couple
that came in.
questions here.
Yeah, can I discuss about the awake and why I choose the awake instead of the sleep well? Um, just uh, just for reference, the awake is an add-on to the sleep well. So the reason I did that is because they're relatively correlated, and The awake's a little bit more aggressive, and it's got leverage in it and all sorts of stuff. So it's basically a tag on. And also you still get the weekly commentary with that and everything. So it was a way to keep them two joined together. Now, the awake is a more aggressive, higher frequency trading. Let me pull up I'll pull up a PowerPoint of like the last monthly presentation, and I can dig into that really quick here. Let me get down here. There we go. Okay, so okay, and screen. All right, so this is in general. This is how assets move in the Sleepwell portfolio. So now this is all the way back from 2007 to current. The yellow is the Sleepwell portfolio. The black is the SPY. I could have put 60-40 up here, but that would have been like really like down here. No, actually, I think a 60-40 does okay. I think it's somewhere around here. It's about half the returns of the SPY, and then we're, so anyway, I'll digress. I'm not getting into that. Anyways, so you can see here, so every color is referenced to a different asset, and the whole height is 100% of capital, right? So at any given time, you can see that when we've got a large dark blue, that, like say this spike right here, that's really deep down in here. It's really small, you can tell, but on that week, we had a lot of SPY, and we had very little of bonds and other things, right? And then as we move forward about a month or two, you can start seeing that we start to get a little bit of gold in here, small caps and SPY. And then we go a little bit further as we go into this correction that happened right here. And we had IWM predominantly, less SPY, and we started to have some emerging markets and US dollar, right? And then as we got deeper into that correction, we had a lot more US dollar, a lot more bonds, and a lot less stock and equity asset, until of course we flipped to the other side of it, and then we predominantly got equities and gold, right? So this is just how you can kind of read this, right? And you can see how this changes, right? And this might look like really busyness, but when you're live moving these assets around, they're not this big of a shift. There can be, the more volatile things are, the more the shifts are. You can see how aggressive it is, or we go from like nothing to like all stocks, and then back to emerging markets, and then all back to stocks, and then gold. Like this is really aggressive, right? But most of the time we're just kind of petering in and petering out, just kind of kicking around. Then we got some more volatility in 2007 or 2017, 18, where we kick in and out of assets really quickly. So it's pretty rare to do that. Of course, you got COVID right here, which was like, we started to move into defensive assets before the drop. And then the drop started to happen, and it was really quickly to kick us out of everything, right? And that's why we were really stable through COVID. And then we kicked back into stocks when we kind of got our green light. Of course, we didn't catch the bottom. We will not almost ever catch the bottom, just FYI. Unless the bottom is a little bit more like of a process. If it's a V bottom like this, we almost will never catch the bottom, just because the macros don't normally shift that fast. And on top of that, all the models are still looking at, well, what's the change? What's happened, right? And so anyways, so that was a really quick turnaround. But normally you'll get some sort of recovery like that. And you'll see this slow bleed out of bonds and into gold and stocks. And anyways, so, but the reference here is how fast this shifts. The awake is a whole nother animal. The awake is much more aggressive to shift in and out of assets. So you can see how fast and how aggressive these spikes are in each individual asset. And so just to kind of like go back and forth, you can see these are slower and then crazy, right? So the awake is much more, it can concentrate a lot more. So for instance, like for it to go 100% stocks one week to 100% gold the next week is nothing for the awake. That would take some crazy volatility to do that in the sleep well portfolio. So in general, the sleep well portfolio is a more conservative approach to moving assets around, where we're not going to put a ton of risk in a single asset. It's going to be a little bit more diversified, but because of the diversification that happens and the slower movement of the SPY or of the sleep well portfolio, you are not able to get the kind of the power behind the concentration that the awake does. Now, with that being said, I also leverage awake in the service, right? So the leverage in the awake, and the way that I leverage, so I increase and decrease leverage based on its performance, right? So if it's underperforming based on its historical averages, I will increase leverage, and as it's overperforming across its historical average, I will decrease leverage. So and I do that part of the service, and you can see that whenever you are in it. I could have shown it, but anyways, you can choose your leverage function and whether you even want to leverage. So typically, rule of thumb, the way that I use awake and the way that I use the sleep well portfolio is my larger, chunkier accounts sit in the sleep well portfolio. My smaller accounts that I can just crank away at and leverage up and take a lot of risk on, and I still don't want that same like I want to hover over this account, right? I'll run it in a leveraged awake and get some alpha out of it, and then I'll just rebalance that, no problem. If I were to just run one, it would depend on what my risk tolerance is. So the awake leveraged can definitely take 20, 25. It wouldn't shock me to take a 30% risk in that trade. So something like that would be what you're talking about. Now, COVID was what, 33% in SPY. You had a 50 some odd percent in the Great Recession. So you're getting pretty close to the risk that stocks are, and it happens more frequently in awake when you're leveraged like that. But you're also going to get not the piddly 12 and 13 or 15% return that the SPY is. You're going to be closer to 45 and 50, 55, 56% returns. So yeah. So anyway, so that's kind of how you choose between the awake and the sleep well portfolio, is based on your risk tolerance, how much you want to leverage it, and how much you're okay being concentrated in a single asset. If it were to cause me stress, that I look at my portfolio and say the market's down or the volatility is really high, and I'm going 100% into small caps, if that were to give me stress in that account, then awake might not be the best choice. Sleep well portfolio will have a lesser likelihood of being in that situation. That does not mean that it doesn't happen, though. So if we look over to sleep well portfolio, there is a blue line here, right, that goes 100% in small caps, right? That is not unheard of for us to do it. It's not common, but it will happen, right? Here's SPY, small caps, and emerging markets right after the bottom in 2008. You wouldn't have known that that's the bottom, though, right? In that moment, if I'm an investor that worries about a further drawdown, and I just went very aggressive into predominantly all equities, right? That's something to note, right? And awake, you can see that awake on that week was very, very, very aggressive in emerging markets. And well, the reason that awake was very aggressive in emerging markets at that same time frame is because we had major devaluation in the US dollar. Now, looking back, we can see that very clearly, but I have models that are only using the data that we know at that moment, right? and they change over time, right? So like what we look at right now is very different than right. So so some of these old portfolios that use bonds to prop themselves up, no, 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 no. That is a scary situation right now. You want something that adapts to current macroeconomic environments. Just because bonds worked in these last corrections back here does not mean I should assume that they're going to work on this one, which is exactly what we saw here. Just to kind of give a reference to this. So if we have a comparison of bonds, right? Bonds did not hedge anything in stocks over this year's correction so far. Nothing. In fact, they made it worse, right? So, and if you're using a portfolio that's dependent on the stock bond correlation or them picking up as a hedge or something like that, you're just going to get your face ripped off when inflation is as high as it is. So that's why the sleep well portfolio, that's a mutating model that is dynamically adjusting to the macroeconomic environment as it currently is, not what it's historically been, but what it currently is. That's why I made the sleep well portfolio in the awake. And remember, it is just a long only portfolio. So it doesn't have any shorts in it or anything like that. So if you look at performance, and we're up very aggressively over the last few weeks, and stocks and bonds have been crashing pretty hard, it's not because we were shorting the market, right? So we're not short the market just because we are rallying. So we're not banking on the market going down. Like, we're actually still long assets. We're still long, purchasing of certain assets, predominantly gold and US dollars, right? US dollar pairs. But that doesn't mean that we're short on the market. So the market can rally and like, we're fine, right? Like, that's okay. That's not a problem. It's not a problem. So anyways, just keep all those things in mind. And the Awake is also a long only portfolio as well. So both Awake and the Sleep Well are both long only. Awake is a little bit more trader oriented, that's willing to have 100% of whatever capital they're using in a single asset. Now, that doesn't mean that it's not diversified, right? If you're in stocks, or say you're in the SPY, you're still diversified across 500, equities. If you're in emerging markets, you're diversified across a bunch of countries. Now, if you're in gold or dollars, that is a little bit more concentrated. But even then, dollar pairs, you're still in, so UUP, you're still across a basket of currencies, right? So you still diversified across multiple currencies, even though it's based on the dollar. And then gold and bonds are the only two things that are not heavily diversified as far as that goes, because gold is just a single asset, and then bonds are a single asset as well. So hopefully that helps with everything. So yeah.
All right, Wayne.
Alrighty. It has been some time, man. Yeah. So this is
Probably time to
get out.
Yeah, go get some dinner or something, right?
Heck yeah. Time to go talk some shop and have some beers with a friend of mine.
There you go. All right, my friend. Thanks everyone for coming. Thanks, Wayne. Great information as always. And and then Antona says, it's for an optimal time to join these portfolios.
Yeah, basically, mid time to join is anytime the portfolios are roughly around like 4% down. The optimum, like if you're like really trying to catch the bottom, 6 to 8% down. We just had one of those though, and they only happen once every couple years. So yeah, somewhere around the 4, which is actually where we're at right now. But somewhere around that 4%, because it's higher volatility right now. Also, the higher the volatility in assets, predominantly the higher the returns. So which is right now higher volatility. But the lower the volatility, the less opportunity there is in general. So it kind of stagnates a little bit more. So higher volatility, medium to large drawdown, which just happened. We just ran a special about the drawdown, but I won't do that again for probably another year and a half. So yeah, it's a great time right now not just saying that in general, but just statistically speaking, somewhere around the 4 to 6% down is the best time.
Sounds great. I just looked, we're down 3.72%. So not a bad time
Perfect.
to get in. Yep.
Yeah. All right,
All
guys.
right. Thank you very
You guys
much.
take care.
Wayne, I think you're still the host. So you have to end the meeting.
I will do so. See you guys.
All right. Bye.